Central banks across the globe have just executed their largest gold purchasing spree since 1967, absorbing over 1,000 metric tons of bullion to hedge against a weaponized US dollar. While retail investors were distracted by the equity melt-up, the People's Bank of China and the National Bank of Poland were quietly decoupling from the Treasury market, signaling a structural fracture in the global monetary order. Good morning and welcome to the CFO Suite Global Intelligence briefing. This pivot toward hard assets isn't a temporary flight to safety. It is a calculated re-architecting of sovereign balance sheets. For decades, the inverse correlation between real yields and gold was the North Star for macro traders. When the 10-year Treasury inflation-protected securities, or TIPS, yield rose, gold fell. But that relationship has shattered. Over the last 18 months, we have seen real yields climb to their highest levels since the 2008 financial crisis, yet gold has simultaneously surged to record highs above $2,400 per ounce. This divergence is the most significant macro signal of the decade. It tells us that the Fed dependency of precious metals is over, replaced by a global scramble for outside money, assets that carry no counterparty risk and cannot be printed by a central bank facing a $34 trillion debt ceiling. The mechanics of this rally are driven by two distinct engines: the sovereign accumulation of gold and the industrial electrification of silver. On the gold side, the People's Bank of China has reported 18 consecutive months of additions to its reserves, officially holding over 72 million troy ounces. However, shadow buying from other BRICS nations suggests the actual flow into sovereign vaults is significantly higher than official IMF reporting indicates. This institutional floor is being reinforced by a shift in the COMEX and London OTC markets, where we are seeing a persistent drain of physical inventory. Total gold held in COMEX-approved vaults has dropped by over 25% from its 2020 peaks, suggesting that the paper gold market is increasingly disconnected from the physical reality of supply and demand. To understand the upside, we have to look at the massive underallocation within the institutional community. Despite the price appreciation, gold and silver currently represent less than 1% of total global pension fund assets. If that allocation were to revert to its 1980s mean of 5%, the capital inflow would exceed $3 trillion. A figure that dwarfs the total annual global mine supply of roughly 3,000 metric tons. We are looking at a classic supply-side squeeze meeting a generational shift in capital allocation. But while gold is the monetary anchor, silver is the high beta play on the energy transition. Silver is currently trading at a gold-to-silver ratio of roughly 80-to-1, significantly higher than the historical 20th century average of 40-to-1. This gap exists despite the fact that silver is facing a structural deficit for the fourth consecutive year. The Silver Institute reports a projected deficit of 215 million ounces in 2024 alone. This isn't just about jewelry or silverware, it's about the photovoltaic, or PV industry. Solar panel manufacturing now consumes over 190 million ounces of silver annually, a figure that has tripled in 5 years as N-type cell technology gains market share. These cells require significantly more silver paste per watt than older P-type models, creating a floor for industrial demand that is entirely price inelastic. The supply side of the silver equation is even more constrained. Over 70% of silver is produced as a byproduct of lead, zinc, and copper mining. This means that silver supply cannot easily respond to higher prices. You cannot simply turn on a silver mine if the primary copper or zinc economics don't justify the capital expenditure. With major operations like First Quantum's Cobra Panama mine facing regulatory shutdowns and Glencore forecasting lower zinc outputs, the incidental silver supply is tightening exactly when the AI-driven data center boom is demanding more silver for high-conductivity electrical contacts and thermal interfaces. If this level of institutional analysis is giving you an edge in navigating these volatile commodity markets, hit that like button and subscribe. We provide this caliber of intelligence every single day to ensure you're ahead of the shift. Moving deeper into the technicals, the breakout in silver above the $30 resistance level marks the end of a decade-long consolidation pattern known as a cup and handle. From a charting perspective, This often precedes a move toward the $50 all-time highs seen in 1980 and 2011. When you combine this technical breakout with the fact that the Shanghai Gold Exchange is frequently trading at a premium of $40 to $50 over the London spot price, it's clear that the price discovery mechanism is shifting from the west to the east. This physical arbitrage is forcing Western bullion banks to scramble for physical delivery to satisfy Asian demand, further depleting COMEX-registered stocks. We also have to account for the fiscal dominance argument. The Congressional Budget Office, or CBO, is projecting interest expense on U.S. debt to exceed $1 trillion annually, more than the entire defense budget. In an environment where the Treasury must issue trillions in new debt to roll over maturing bonds, the Federal Reserve may eventually be forced into yield curve control, or YCC, to keep borrowing costs manageable. Historically, every instance of YCC, or massive liquidity injection, has been a massive tailwind for precious metals. Gold isn't just a hedge against inflation anymore. It is a hedge against the potential for financial repression, where interest rates are kept artificially lower than the rate of inflation to melt away the real value of government debt. For the CFO and the institutional treasurer, the play here is moving beyond physical bullion into the senior producers. Companies like Newmont and Agnico Eagle have spent the last 3 years cleaning up their balance sheets and focusing on Tier 1 jurisdictions like Nevada and Ontario. With gold trading above $2,300, these miners are generating massive free cash flow as their all-in sustaining costs, or AISC, generally sit between $1,200 and $1,400 per ounce. We are entering a period where these companies will likely shift from debt repayment to aggressive dividend hikes and share buybacks, offering a leveraged play on the underlying metal price. The risks to this thesis remain a higher for longer stance from the Fed that strengthens the DXY, or US dollar index in the short term, or a sudden de-escalation in Middle Eastern geopolitical tensions. However, even in a cooling geopolitical environment, the structural deficit in silver and the central bank diversification into gold provide a margin of safety that didn't exist in previous cycles. The Goldilocks era of low debt and stable geopolitics is over, and the market is finally repricing the world's oldest currency to reflect that reality. As we look toward the final quarter of the year, watch the 100-day moving average on silver and the central bank gold purchase reports from India and Turkey. These are the indicators that will confirm if the floor is holding. If you want to ensure your portfolio is positioned for this structural shift in the commodities complex, make sure you are subscribed to our channel for our deep dive updates. Our confidence score for this bullish trajectory in gold and silver is 88%. This analysis is powered by the CFO Suite. For more institutional-grade financial intelligence and real-time data on the precious metals complex, visit thecfosuite.ai. This content is for informational purposes only and should not be considered financial advice. Always consult a qualified financial advisor before making investment decisions.